America's financial reckoning record markets, record debt, and a job shock that changed everything. The United States economy has just delivered a surprise that nobody saw coming. Wall Street expected a slowdown. Economists predicted roughly 85,000 new jobs in May. Instead, America added 172,000 jobs, more than double expectations. On the surface, that sounds like incredible news. More jobs, more paychecks, more economic activity. But within hours of the announcement, something strange happened. Stocks plunged, technology shares were hammered, Treasury yields surged, and investors began dumping some of the hottest AI stocks in the world. So how can good news cause panic? Why would a strong economy make Wall Street nervous? And why are experts warning that America may be approaching one of the most dangerous financial crossroads in modern history? Today, we're connecting the dots. Because behind the headlines lies a story about debt, artificial intelligence, inflation, war, and the future of the world's largest economy. This is America's financial reckoning. The job shock. The story begins with one number, 172,000. That's how many jobs the American economy created in May. For most people, that sounds positive. After all, jobs are the foundation of economic growth. People work. People earn money. People spend money. Businesses grow. The economy expands. Simple. But financial markets don't just care about what's happening today. They care about what happens next. And that's where the problem begins. For months, investors have been betting that the Federal Reserve would start cutting interest rates. Lower rates make borrowing cheaper. They encourage spending. And most importantly for Wall Street, they tend to push stock prices higher. But a booming jobs market changes everything. If employers are still hiring aggressively, if unemployment remains low, if consumers keep spending, then the Federal Reserve has far less reason to cut rates. In fact, it may do nothing at all. And that's exactly what frightened investors. Immediately after the jobs report, bond yields surged. The benchmark 10-year Treasury climbed to levels not seen in months. As borrowing costs rose, investors began rethinking their bets on growth stocks. And nowhere was the damage more visible than in technology. The AI gold rush. For the last 2 years, one story has dominated Wall Street: artificial intelligence. Companies connected to AI have become the modern equivalent of a gold rush. At the center of that revolution stands NVIDIA, the company that designs the powerful chips driving AI systems around the world. Only days before this jobs report, NVIDIA CEO Jensen Huang stood before thousands of people and unveiled what he described as the next major leap in computing, a new generation of AI-powered hardware designed to bring supercomputer-level intelligence directly to personal computers. Investors loved it. NVIDIA surged. Dell surged. HP surged. AI enthusiasm spread to the market like wildfire. Billions of dollars poured into technology stocks. But then reality arrived. Several companies released earnings that failed to match the market's sky-high expectations. Not terrible results, just not extraordinary enough. And that's the danger of a bubble. The higher expectations climb, the harder it becomes to satisfy investors. Soon profit-taking began. Chip stocks fell sharply. Major AI names lost billions in market value within hours. And investors started asking a difficult question. Has Wall Street become too optimistic about artificial intelligence? Or can these companies actually generate enough profits to justify their massive valuations? The AI revolution may be real, but history teaches us that even revolutionary technologies can become overvalued. Just ask investors from the dot-com era, the Fed's impossible choice. Now we arrive at the institution, holding perhaps the most power over financial markets today, the Federal Reserve. Led by Chairman Jerome Powell, the Fed has spent years fighting inflation, raising interest rates to cool demand and bring prices under control. And while inflation has fallen significantly from its peak, the battle isn't over. Today's jobs report has complicated everything because the Fed now faces a dilemma. Cut rates too soon and inflation could return. Keep rates too high for too long and economic growth could slow dramatically. It's a balancing act with enormous consequences. Mortgage payments, car loans, business borrowing, Credit card debt. All of it depends on where interest rates go next. And unfortunately for Powell, he isn't dealing with just one problem. He's dealing with several at once. Trade tensions continue to pressure supply chains. Global conflicts threaten energy markets. And government debt continues climbing at an alarming pace. Each issue alone would be difficult. Together, they create one of the most challenging economic environments in years. The debt crisis nobody can ignore. While investors focus on AI and interest rates, another number continues rising quietly in the background: America's national debt. Today, U.S. government debt exceeds $36 trillion. That's more than the entire annual economic output of many major nations combined. And the number continues growing. Every year, the government spends more than it collects. The difference is borrowed. For decades, this system functioned because interest rates remained relatively low. But now rates are higher, which means servicing that debt has become dramatically more expensive. In fact, interest payments on the national debt are now among the largest expenses in the federal budget. Think about that for a moment. The government is spending enormous sums simply to pay interest on money it has already borrowed. And if borrowing costs remain elevated, that burden grows even larger. This is why organizations around the world are beginning to issue warnings, not because a crisis is guaranteed, but because the margin for error is shrinking. The strange bull market. Here's the contradiction that makes today's market so fascinating. Despite rising debt, despite geopolitical uncertainty, despite elevated interest rates, despite inflation concerns, the stock market recently reached record highs. The S&P 500 continues hovering near historic levels. The Dow Jones has repeatedly broken records, and technology companies remain worth trillions of dollars. How is that possible? Because investors still believe in one thing: growth. They believe artificial intelligence will transform industries. They believe corporate profits will.
Welcome to Mkidi Studios.